Hi everyone and welcome to today's morning report on Friday the 5th of August with me, Richard Perry, market analyst at Handset Markets. We've got a fairly sort of cautious-ish, I suppose, open to the day. It's Non-farm Payrolls Friday today, and we've got markets or equity markets that are mildly higher, sort of around about 0.5% on FTSE DAX and a little bit more on the CAC. Interesting that we've seen a bit of a move back against the dollar. Sort of last couple of days of a dollar rally. But just giving back some of that in front of this payrolls decision, payrolls report today, maybe suggests the market is a little bit cautious in terms of how strong this report's going to be. But certainly at the moment it's fairly middle of the road in terms of what the market's expecting. Just look at this here. We've got the headline around about 180. Actually, let me just show you the data. Actually. Headline 180, unemployment dropping back to 4.8%. It'll be interesting to see what that does to the participation rate. 62.7 today, or currently is the level there, and also average hourly earnings of 0.2. Now that is interesting because last month was at 0.1%. Let me show you. Where is it? Here. Here's the data. Average hourly earnings fell to 0.1%. So it's a slightly underwhelming move there, but still 2.6% on the average hourly earnings year-on-year data. So again, is expected to just remain around that 2.6%. So that's not really shooting the lights out in terms of what the Fed wants. The Fed would want to see a strong report to really sort of usher in a move towards interest rate hikes. But it doesn't look as though that the market's going to get that today, and I think that the expectations of a December rate hike may be where we're at. Market sort of had been sort of around 50% on December, sort of cut back to around about sort of 35-40 in the wake of the FOMC decision and also the data that we had, the ISM data this week. But if we got a strong payrolls report, maybe that would improve back towards 50 again, putting the December rate hike back on the table as a possibility. But it certainly doesn't look at the moment as though that they're going to get a rate hike in front of December. So how does this all leave our markets? Well, European equities are, as I said, mildly higher, nothing too significant, but mildly risk positive today in front of the decision. Now, that takes me on to my chart of the day, which is the Aussie dollar. Now, we've had this rally actually in Aussie dollar against the US. And it's continued over the last couple of months, actually, a succession of higher lows, and it's sort of building towards this resistance, isn't it? And again, we're sort of testing this 76.50 area resistance that we've just had a couple of pokes at. 76.75 basically is the high, and that's sort of protecting these highs back from April. But if you got a breakout above 76.75, I think obviously that would reopen this higher 78.35, which is the big 2016 high. But you look at these momentum indicators, it'll be interesting to see if the RSI, I think, if the RSI can hold this move towards 60 every time, tends to be through this run higher. Pretty much every time we've got towards that 60 level, it's failed. I mean, yes, you had that run in June and just prior to the Brexit decision, but I suppose you can argue that was a bit of an anomaly potentially. But other than that, every time the RSI gets towards 60, it sort of tends to come up in a bit of a struggle. MACD lines, again, not really shooting the lights out in terms of strength of the trend. Stochastics suggest near-term positive, so that is good for the test of the resistance band. Here we see on the hourly chart, we see configured positively. I was sort of looking at this yesterday thinking that could potentially be a bit of a small negative divergence, but it doesn't seem as though that's taking really too much influence here. And the outlook, I think, on the MACD lines is actually reasonably positive, but the RSI continues to go towards 70, put pressure on that, finding support around the 50 area. So I think that generally speaking, we've got a good setup, rising moving averages on the hourly. So it's all pretty much set up for buying into little corrections at the moment. Now this 75 level is a pivot and has been throughout July, or was throughout July. And again found the little correction earlier on the week on Wednesday, found support and used that as the basis of support for the push higher again. So that is clearly your key support, 75.75, and that also coincides with the moving average support as well, which is the 144-hour moving average. So there's several reasons why that is a key support near term. But in terms of your sort of assault on or above 76.50, initially moved to 76.60, but just again a few corrective candles. You could argue that this, if I zoom in, you could argue that this is a corrective candle here that we had a couple of hours ago. 76.47. Very, very close to being a big bearish engulfing at 1 hour candle. As the hourly RSI just sort of goes to sort of a level that has tended to be sort of limiting, really. Again, over the last few days, every time the RSI gets towards sort of 70 or just above, just drops away again. So maybe that it looks as though the Aussie is going to consolidate. I mean, you'd expect the Aussie to consolidate anyway in front of payrolls, but it seems to be on the chart as though that's what's happening anyway. But certainly I think that payrolls are likely to provide volatility and possibility. If it's not a positive or not a strong report, you could see a bit of an Aussie breakout. But yeah, a bit of volatility I think around this report. Obviously, if it's in line, it could be a bit choppy and uncertain in terms of the reaction. But technically speaking, the Aussie is still pretty strong on a near to medium term basis. So I wish you good luck in your trading today, and I will speak to you later. Thank you.